December is here, and everyone wants to talk about the Santa rally. But the real story is not seasonality, it is whether the Fed cuts rates and whether the consumer can keep spending. This month may end with a gain or a lump of coal, and it all comes down to Joe Consumer. Welcome to December. We made it after a November that was supposed to be the icing on the bull market rally cake. Well, the cake never quite set. November is historically a strong month for stocks, but history is just history. Those are observations, not predictions. And this November proved that point perfectly. It looked good until it didn't. By mid-month, things got a little ugly. Tech and AI, our market leaders, got hammered by bubble talk, by overvalue talk, by the usual parade of doomers ready to declare the end of innovation. But the real story was not AI at all. The real story was the Fed. Rate cut odds went from nearly certain to maybe to probably not in just a few short weeks. Powell said no guarantee, and that was all that the market needed to hear. But something shifted. Despite the government shutdown choking off federal data, private data began to roll in, and that data, well, it wasn't pretty. Employment looked softer, confidence sank, and purchasing managers reported weaker corporate sentiment. The economy wasn't falling apart, but it was definitely losing momentum. And with that weakness came a new expectation. The Fed would once again be forced into action. Rate cut probabilities climbed back up, and they climbed fast, enough to let the S&P 500 squeak out a small gain for the month. Not a celebration at all, but a survival. And now we're here, December, with an FOMC meeting next week. And this morning, Fed funds futures showed a 100% probability of a 25 basis point cut. And because Wall Street cannot help itself, people are already talking about 2026. One cut in December, 3 cuts next year. The countdown has already begun. And if that happens, Fed funds would drop from 4% today to around 3% a year from now. Sounds great in a headline, but what does it really mean? Well, for banks, the Fed funds is the rate that they charge each other for overnight borrowing. Doesn't exactly move most people's hearts. For corporations, it helps lower borrowing costs, and yes, there is an economic tie-in. But for the average person, what does it mean? And that is where the real story begins, because lower rates don't magically transform the economy. Lower rates hit the economy through one primary channel, through the consumer. My favorite topic. Consumption is not just part of GDP, it's the whole show. Nearly 70% of the US economic activity. When the consumer wobbles, the economy wobbles. When the consumer spends, companies breathe. And when the consumer tightens up, markets catch a cold. And what keeps the modern consumer spending? Not income, not raises, not savings, credit. Pure, relentless, always available credit. Total consumer credit outstanding is above $5 trillion and climbing, and credit cards alone are above $1 trillion. That's how Americans are keeping up with prices and lifestyles that have outrun their paychecks. Which brings us to my friend Joe. Joe's not a case study. He's everyone you know, including you, if you're being honest. Good job, good income, expensive city, and a lifestyle that always seems to outrun reality, just a little. Joe puts $4,000 to $6,000 a month on credit cards. He pays some of it, not all of it, and he always thinks that he will pay them down eventually. But eventually usually never comes. So what happens when the Fed cuts rates by 1%? Joe's minimum payment drops $20 or $30 a month. Not life-changing, but behavior changing. Joe feels relief, and when Joe feels relief, he doesn't pay down debt, he spends more. He buys the gifts, he buys the trip, he upgrades the phone, he buys the nicer wine with a fancy label. And that's how monetary policy works in America, not through corporate capex models or Nobel Prize-winning equations, through people like my friend Joe. Rate cuts ease the monthly payment burden, enough to boost short-term spending, enough to keep earnings supported, and enough to keep markets afloat. But there's a massive warning here. A rate cut only works if Joe keeps his job, if income holds, if employers don't start cutting headcount to protect margins. Because once Joe loses his job, $20 off a minimum payment does absolutely nothing. At that point, the likelihood of delinquency actually explodes, and a rate cut can't replace a paycheck. That's the real risk beneath the surface. It's not just inflation that matters anymore, it's the labor market. The job market is the actual linchpin of the December story. But let's look at December anyway. Over the last 20 years, the S&P 500 has finished December higher in 12 of them. The average return is about 0.59%. Not too bad, not amazing. Better than November this time round. The Santa rally, the last few days of December, first few of January, is a fun little market myth that has just enough truth to keep everyone talking about it. Call it a convenient observation. Maybe it happens, maybe it doesn't. This year, the real driver will not be Santa. It'll be Powell. It'll be what the Fed does and says next week. That'll tell us whether December ends with a gain or with a lump of coal. So, your truth bomb for today is this. December only works if the consumer holds the line, because the Fed can cut rates, but it cannot save a lost paycheck if it's too late on the trigger. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.